Welcome to this explainer. Look, if you're a focused learner trying to cut through all the financial noise and stop overpaying for investments, you are absolutely in the right place. In a market completely packed with hype, endless social media tips, and flashing red and green numbers, it is so easy to get burned. But today, we're going to shatter this massive myth of the cheap stock price. We're going to build your ultimate toolkit for stock valuation, relying purely on the data and the raw math of a business. Let's kick this off with a question that's going to seem super obvious, just to show how we naturally get the concept of value in the real world. If someone offered you a giant apple for $5 and a tiny one for $10, which is the better deal? The giant one, right? No contest. You're getting way more actual apple for your money. But it's crazy how when people jump into the stock market, they completely toss this everyday logic out the window. They see a stock trading at $5 a share and immediately think, wow, dirt cheap. Then they look at a $500 stock and say, no way, too expensive, I can't afford that. Well, we're going to fix that mindset right now. Because thinking like that is actually really dangerous. A stock price is literally just a sliced up fraction of a company. Check this out. Imagine two identical pizza shops, right? Both are bringing in exactly $1 million in profit every single year. Pizza shop A slices its ownership into 1,000 shares, so each share is $1,000. Pizza shop B, on the other hand, slices its ownership into 1,000,000 shares, meaning a share only costs $1. Sure, shop B's stock looks a lot cheaper to a rookie, but both companies are worth the exact same amount of money. Buying one share of shop A gets you $1,000 worth of profit. Buying one share of shop B gets you exactly $1 worth of profit. Mathematically, a $1 stock isn't inherently cheaper than a $1,000 stock. It's just sliced thinner. So, to compare them fairly, we need a real investor's toolkit. In this explainer, we're going to unlock 5 key things step by step. 1. The price tag illusion. 2. Unlocking the PE ratio. 3. Factoring in future growth. 4. The core cash flow engine. And finally, number 5, avoiding deadly value traps. All right, let's jump right into section 1, the price tag illusion. Think about two houses for a second. House A costs £200,000. House B costs £500,000. Which one's too expensive? The truth is, you literally can't tell without knowing the location, the square footage, the condition, or what kind of rent it could bring in. A 200 grand crumbling shed in the middle of nowhere? Wildly overpriced. But a 500 grand massive mansion right in a prime city center? That's an absolute steal. And stocks work exactly the same way. The share price by itself tells you basically nothing about what you're actually getting. The really crucial point here is nailing down the fundamental difference between price and value. Price is simply what the market is asking today. It's the sticker on the window. Value, though, is what the business is actually worth under the hood. Remember, when you buy a stock, you're buying a tangible piece of a real business, not just some ticker symbol bouncing around on a glowing screen. You have to figure out what you're getting for the money. Are they actually making a profit? Are they drowning in debt? Are they going to be successful in 10 years? Cheap simply means the price is less than the value. Expensive means the price is greater than the value. It really is that simple, yet getting this mixed up is the most common mistake made in the market. Which brings us perfectly to section 2, unlocking the PE ratio. Okay, so the price to earnings ratio, or PE ratio, is the undisputed king of beginner metrics out there, and for good reason. It's incredibly simple and gets straight to the point. You just take the current share price and divide it by the company's earnings per share, which is basically their profit over the last year. Think of this simple formula as your rapid shortcut. It instantly tells you exactly how many years it would take for a company to earn back your initial investment, assuming its profit stayed totally flat forever. Let's break down the math clearly. Say a stock is trading at £100 a share, and the company earns £10 a share in profit every year. You've got a PE ratio of 10. That simply means investors are paying £10 for every £1 of annual earnings. Generally speaking, a lower PE implies a cheaper stock. A higher PE? Well, that means you're paying a pretty hefty premium for that exact same £1 of profit. But here is where it gets incredibly interesting. Take a real-world example like Walmart, whose 2026 PE ratio actually hit 48.15. Now, why on earth would anyone willingly pay over $48 to get just one single dollar of earnings? It's because investors gladly pay a massive premium when they expect really fast future growth. A high PE is basically the market saying, hey, we expect this company to grow so rapidly that those future earnings will easily justify the high price we're paying today. People are paying for tomorrow's potential, not just today's reality. But you absolutely cannot look at a PE ratio in a vacuum. You have to follow the golden rule here. Context is everything. Valuation only makes sense when you're comparing apples to apples. A PE of 30 might be an amazing bargain for a fast-growing tech firm, but wildly, terribly expensive for a slow-moving utility company. Comparing Apple to Microsoft makes perfect sense, right? They operate in similar spaces with similar scaling potential. But comparing Apple to Coca-Cola or your local water provider, not so much. Different industries naturally trade at completely different valuation levels based on how fast they grow and how much capital they need to operate. So always, always compare a stock to its direct peers.
Let's peel back another layer of the onion with Section 3, factoring in future growth. Because relying purely on past earnings just isn't enough if a company is growing at lightning speed. You need to meet the PEG ratio. That stands for price to earnings to growth. This is a brilliant, beginner-friendly way to adjust the standard PE ratio for those high growth expectations we were just talking about. See, a standard PE might make a fast-grown company look terrifyingly expensive, but the PEG ratio levels the playing field. You simply take the PE ratio and divide it by how fast the company's earnings are actually growing. It perfectly balances out the slow, steady companies against the fast, aggressive ones, giving you a crystal clear picture of relative value. And this brilliantly illustrates the golden benchmark, a PEG ratio of 1.0. If it's right around 1, it means the stock is fairly valued relative to its expected growth. But if you find a PEG ratio of 1.0 or lower, that is generally considered a fantastic deal. It means you're getting a high growth at a totally reasonable price. Basically, the market hasn't fully priced in just how fast the company is expanding its profits, creating a huge window of opportunity for a savvy investor. But what if a company is brand new? What if they're relentlessly reinvesting every single penny into capturing market share, meaning they currently have zero profit? Well, they don't have earnings, so PE and PEG ratios are completely useless. That is where our savior metric steps in. The PS ratio, or price to sales. This compares the total value of the company directly to its total revenue. It tells you exactly what you're paying for every single dollar of sales coming through the door, before any expenses are even paid. If a company has a PS ratio way below its competitors, the market might be severely undervaluing its revenue, making it a hidden bargain just waiting to be uncovered. Moving right along to the absolute fundamental core of our engine, Section 4, the core cash flow engine. We've looked at earnings and sales, but cash flow is the true economic engine of any business. You know, you can massage earnings with clever accounting tricks, but cash is cash. Paper profits simply don't pay the bills. Actual cash in the bank does. Enter the free cash flow yield. You calculate this by dividing the free cash flow by the market cap. A higher yield means a cheaper stock relative to the actual tangible cash it generates. Honestly, stripping away all the accounting noise, this is one of the absolute most reliable anchors you can use to determine a company's intrinsic value. Ultimately, every single valuation shortcut we've discussed today is just trying to approximate one major concept, discounted cash flow, or DCF. Now, a full DCF is pretty complex to calculate manually, but the fundamental intuition behind it is super simple and incredibly powerful. It literally just means this. If a company is going to generate more cash in the future, it is fundamentally worth more today. That is the backbone of all valuation, whether you're looking at a tiny local bakery or a trillion-dollar tech conglomerate. Now that we have the tools, we've got to ensure you don't lose your money. Section 5. Avoiding deadly value traps. I need to emphatically warn you right here, a low PE or a low PS does absolutely not guarantee a bargain. This is probably the most devastating mistake I see beginners make. Sometimes a stock looks incredibly cheap because it's a trap. You have got to look for the warning signs. Are sales consistently falling? Are profit margins shrinking? Is their debt ballooning quarter over quarter? A truly great investor doesn't just look at a stock and ask, is this cheap? They immediately follow up with, wait, why is it cheap? More often than not, the broader market has already spotted these severe underlying business problems, and the stock is cheap for a very good reason. Whatever you do, don't catch a falling knife. So let's synthesize everything we've learned into a highly actionable checklist. Before you buy your next stock, pull up your favorite free financial app and systematically ask these 5 questions. Number 1, is it actually making money? Number 2, is it growing? Number 3, what is its PE or PS ratio? Number 4, how does it compare to its direct peers in the same industry? And number 5, why is it valued this way? By strictly walking through these exact steps, you force yourself to look deeply under the hood of the business, completely ignoring that glowing, distracting price tag on the screen. I'm going to leave you with this ultimate investing truth from the legendary Warren Buffett. Price is what you pay, value is what you get. Learning the difference between those two things is quite literally one of the most vital financial skills you will ever develop.
So, now that you've officially shattered the price tag illusion, I've got a challenge for you. Look closely at your own portfolio or those stocks you've had on your watch list. What company are you going to analyze and value first using your brand new toolkit? Dive in, run the numbers, and let the fundamentals guide you.